Hey, what's up, dividend investors? Mikey Roux here for Dividend Stocks Rock. Welcome to this channel. Today, I am super excited because I am starting a whole new portfolio. Not a mock portfolio, but actually every month on this channel, I will be investing $1,000 in a new stock. My goal is to show you how you can build your portfolio one step at a time by adding a new position every single month. I will discuss the company, but also the portfolio performance overall. Right now, investing at an all-time high market is pretty difficult. So instead of trying to go for valuation or go for a beaten stock, I will focus on companies with a robust set of metrics. So throughout those analysis, you will learn a little bit more about the dividend triangle and how I make those analysis. So for those who are new to the channel, the dividend triangle is the foundation of my investment analysis process, which is comprised into three different metrics. So I am following first the revenue trend. So what I want to see here is a company that is able to grow their sales year over year on a steady basis. That tells me the strength of the company and definitely that their playbook is working. Once I found a company showing a solid revenue growth trend, I also want to look at earnings per share. Same thing, I want to look at the past 5 and 10 years to see if the company has some pricing power, cost under control, and maintain their margin. In other words, whenever the company is making more sales, I also want that company to make more profit. And what happens when you find a business that is able to grow their revenue and grow their profit every single year for a long period of time? Well, you expect them to share the wealth with shareholders. So the third part of the dividend triangle is the dividend growth trend. So again, I want to see what's the relationship with how fast the company grows their earnings versus their dividend. Is it a dividend trap that offers a high yield but absolutely no dividend growth, which would be a major red flag in this case, or if is it a company that is thriving in all aspects of the dividend triangle, and at this point, well, I really want to add this company to my portfolio. This focus on metrics is also a good way to stay away from the paralysis by analysis and give me a little bit more conviction in investing at an all-time high market. So if you are interested in this new series, don't forget to subscribe to this channel to not miss any of those videos. So let's get started with my number one pick for February. So the company that I am investing $1,000, and it will be, drumroll, Waste Connection. I decided to go for the third largest integrated provider of solid waste management and recycling services in North America. And today we're going to take a look at the dividend triangle analysis, and I will end this video with a bull and also a bear case because unfortunately there are no perfect investments and it's important to understand the risk that you are getting yourself into. Of course, do not take this video as a buy or sell recommendation. I'm not your advisor, so you'll have to do your own due diligence and verify if Waste Connection is a good fit for your portfolio. So let's get started with the first item of the dividend triangle, the revenue growth. Revenue trend on this one, if you look at the graph, well, it increases steadily pretty much every single year. The secret, well, the company has a lot of contracts. So the business has a predictable cash flow coming up with all the contracts they sign with municipalities. About 40% of their business is coming from exclusive or franchise market, and then 60% from competitive markets, which are primarily secondary or rural market with great margin and a higher market share. Strong with this recurring revenue base, it also uses its cash flow to grow by acquisition. Since 2020, the company succeeded with over 100 acquisitions. Finally, the revenue source is well spread across many states in the US and many provinces. In fact, 86% of the revenue is coming from the US across 46 states and 14% from Canada across 6 provinces. So now that we have established that Waste Connection as a robust business model based on a lot of contracts and recurring revenues, let's take a look at the earnings per share trend over the past 10 years. As you can see, this one is also growing pretty much much every year. From time to time, you will see a small drop into earnings or a small gain, mostly because you will have more acquisitions and more accounting numbers being moved around, and therefore it will create those fluctuations on the graph. However, when you look at the overall growth rate, it is on a similar pace. This shows that the company also have a lot of pricing power. Of course, with 40% of exclusive markets, it's pretty easy to just set the bar and pretty much deal with that. They also have a predictable cash flow business model, so that helps to maintain their costs and maintain great margin. Finally, their focus on secondary and in rural market offer them a great way to improve their margin on those specific markets. So when the revenue and the earnings are growing pretty much at the same pace, this is a pretty good sign. I can then move into the third part of the dividend triangle and look at what the dividend growth trend looks like. Well, this one is quite impressive. We're talking about double digit since the inception of the dividend, so in 2010. So it's been 15 years that the company offers double digit dividend growth rate. It shows a relatively low payout ratio, all thanks to an efficient cash flow management and also a very good capital allocation. So the company will focus on making a lot of acquisition in this highly fragmented market. So that's their number one priority. The second one is to making sure that the debt is under control. So the balance sheet is always robust. The company keeps on generating more cash flow, and it uses its cash flow to A, buy more acquisition, B, buy back more shares, and C, continue this double-digit dividend growth trend. This is kind of like the secret recipe for a solid dividend grower. The only downside that you're surely going to highlight is the fact that Waste Connection doesn't offer a high yield. Yes, the yield sucks, but actually it's because the company is a low yield, high dividend grower. And to be honest, after a lot of research, what I've discovered is that low yield, high dividend growth are actually better and safer than high yielding stocks. I know it's really tempting to have a 5, 6, 7% yield portfolio, but really you're going after a lot of risk. If you don't believe me, you can download the Dividend Income for Life guide that explain why a company is paying a high yield and why a low yield, high growth company is actually better even at retirement. In this guide, you will see an example of a retirement portfolio and how you can create your own dividend income from this type of strategy. So you can go to dividendstocksrock.com/income to download your free guide now. Now let's move on to the bull case and the bear case. So on the bull case for Waste Connection, well, it sounds pretty much obvious, right? The company has a very strong moat with their contracts that generates a lot of predictable revenue. So they're well established in their market, they generate that revenue, and they can use that money to grow by acquisition. They have a lot of pricing power, which leads to the good margin and stable earnings growth. Finally, the mix between organic growth and growth by acquisition is the perfect one to ensure a stability in the business model and to be recession resistant. Unfortunately, there are always some risks to consider, so there is a bear case for Waste Connection. The first one is the company will not be able to grow that much if it only counts on organic growth. Therefore, the growth by acquisition model is always at the center of its business playbook. The problem with that is you always have acquisition risk, right? The risk of integration, the risk of having too much debt, the risk of paying too much for the acquisition, and at one point, the risk of not having enough companies to acquire to move the needle. The other major downside for Waste Connection is the fact that municipalities are now putting a lot of pressure and a lot of promotion actually to reduce solid waste. If you have less solid waste, that will of course lead to less revenue and less earnings for Waste Connection. Finally, probably the biggest downside, which I don't mind too much on my side, but I'm pretty sure that some investors focus on valuation will cringe when they will look at the PE ratio. The business is priced for perfection. So as long as the business is able to grow by high single digit to double digit numbers around the dividend triangle, including the revenue, the earnings, and the dividend trend, everything will be fine. But if they have a few bad quarters showing some slowdown, of course, the stock price will likely drop by 10 or 20% rapidly. Why? Because you have to pay a steep price for Waste Connection right now. Since I'm buying for several decades ahead, I don't really mind about the timing of investing in that kind of company. And to be fair, if you look at the PE ratio over the past 5, 10, and 15 years, you always end up paying a pretty steep price for this type of business model. In other words, there is a price for quality. Before I let you go, I also like to look at some competitors or other options when I look at a stock. So I also did a quick analysis of Waste Management, which is a great competitor to Waste Connection. I use the Dividend Rock stock comparison tool to make my mind quite fast in this case. As you can see here, the company shows a much stronger dividend triangle for the revenue, the earnings, and the dividend. All the numbers are stronger for Waste Connection than Waste Management. And if you look at the dividend metrics, well, Waste Connection shows lower payout ratio, lower cash payout ratio, and a stronger dividend growth trend. Yes, Waste Management is a little bit bigger and also shows a longer dividend growth streak, but the dividend growth rate is a lot more generous with Waste Connection. This is the reason why I decided to go for this one. So to wrap this up, I want to see you in the comment. Let me know what you think about Waste Connection. Is there any other companies that you would like me to review in the meantime as well? As usual, do not forget to subscribe and like this channel just to make sure that you don't miss any of those videos of this new series and the next video that will be published next Thursday. And until then, don't forget to stay invested.